Back with closing trades right here on ET Now and in the thick of earnings. So let's welcome on board Shyam Srinivasan, the MD and CEO at Federal Bank, to talk about their numbers. Shyam, good to have you on the show. Walk us through the key highlights for the quarter gone by in terms of earnings.
I think Q2 for us was indeed the best quarter ever on many counts. We had our highest operating profit ever. We crossed 1,000 crores, 1,007 crores this quarter. Our NII was at an all-time high at 1,380 crores. Our other income was at an all-time high at 509 crores. Our cost-income ratio came down to a multi-quarter low at 46.7, and our NIM improved to a 5-quarter high. So essentially, it's a very strong operating performance. And we backed that operating performance by increasing or providing materially for prospective stress that may happen, and believing that we should be well provisioned. So that really marks the highlights of the quarter. Performance-wise, strong. And we believe we are positioned to gain share as we've been gaining over the last few quarters. And I'm confident that in the environment that all of us are operating in, the bank is positioned to do better as the things sort of begin to look better economically. Health-wise, there may be challenges, but I think economically, India begins to look better, and we are positioned to gain share on a sequential basis. So strong quarter, backed by very deep underlying improvements on every area.
Sure. Let's also talk about the deposit franchise build-up, which has been great in the quarter gone by. Are you consuming now market share even further?
Our quarter for deposits, like you would have seen, the overall deposit growth is 12%, but our sequential and Y-on-Y growth on CASA was exceptional. Our CASA ratio crossed 33.67% this quarter and grew about 20% Y-on-Y. So the good news is the savings and current account have grown. And even better news is both what we divide the bank into Network 1 and Network 2. So all our geographies have had very strong performance. In Network 2, for the first time, we crossed 30% CASA ratio. So by itself, if you take Network 2 as a bank and run it, that bank is running at 30% CASA, which is better than many other franchises in the country. So I think strength in liabilities continues. And in tough times, if liabilities grows, you know that the franchise is being respected and customers find value in this franchise. I'm pleased that that continues. Our share of deposits has grown and has been growing. And we believe that will continue. We've had a range of offerings. Our debit card spend is now, I think we are the 5th largest private sector bank in debit card spend. So we've entered the top 5. And that again suggests that the retailness of the franchise on the liability side is improving every quarter.
Sure. Gold loans have also grown 54%, and we've seen substantial growth over the quarter. Sequential double-digit growth has occurred apparently. Talk us through, whether or not the numbers, are shaping up in that sense, and if you're going to continue to see that kind of traction on that front.
Sure. Sequentially, I think this quarter itself, we grew about 13-14% sequentially, right? Last quarter, we grew 10, and this quarter, another 13-14%. This has been a strength of the bank in the past. For the last 3-4 years, up to 2019, we had cooled off on this. And then that was also environment-led, and we believed that this is an opportunity. Last year, if you remember, we grew about 29%. So we said this is an opportunity that is there, and typically gold business tends to be counter-cyclical when other businesses are under some kind of slowdown, or particularly retail unsecured, which we are not part of. When other banks are cooling off, it's a remarkable opportunity to go out and do gold. And so natural strength of the bank. And when we see something is growing at 50% 2 successive quarters, it's not just one-off, nor is it one location. It's sort of spread across the franchise. And all our branches have come to the party, so to say, and are doing a remarkable job. Our offerings are very competitive, and the brand experience is probably good. And we believe that growth on this business is good to have. It's secured, as you know. It's low capital, no capital consumption. So it's a very productive, sensible business to grow in times like this. And importantly, customers want it because it gives them that sort of space to rebuild their lives through this period.
Okay, what are the factors impacting NIM apart from low cost of deposits? Is it to do with the product mix, or is it largely the retail liability effect?
No, I think to expect this kind of increase every quarter would be rather bizarre. But growth in NIM is pretty much along guided lines. One is we had said the mix of business, particularly as we pivot into relatively higher margin, more secure businesses like gold, there's a expansion in margin. Second is when we have such a high growth in our savings and current account, it again gives you a cost of funds benefit. So the better or lower cost deposits growing quite nicely. And as you know, we are largely a retail liability franchise, very granular, and that has become even more granular this quarter. Our core deposits is 97%. And so our deposit franchise continues to be very strong. And credit growth, we've reshaped the business, the relatively higher margin, lower capital consumption, secured businesses like gold, the government guaranteed scheme, and retail personal loan and some other products have all tracked well. So the blended impact has given a yield kicker on assets and a lower cost of deposits. We believe this should be, we had said that as we sort of come to a shape of the business which is more representative of what we would like to do, it should be in the 310 to 315. We're bang on. We're in that space.
Sure. Also, what is the outlook on NPS, Shyam, going forward? Because right now one is not seeing any large spike kicking in. Will we see a bump up perhaps a few quarters down the line though?
No, I think it all depends on how the whole environment shapes up, as sort of COVID. I'm not saying the health aspect has disappeared, but the business climate in this environment is slowly beginning to come back to terms, at least at 80-90% of pre-COVID levels. So in that context, as people get back to business and start getting on with their lives, we believe credit quality may see some near-term dip, but in a 2-3 quarter, it should all get back to normal run rates. We were a bank that was running at 60-70 basis points credit cost for many quarters, and we as you can see, we made substantial increase in provisions. So between our current run rate on credit cost plus the provisions made, we should be reasonably well padded up.
Sure. Okay, last question to you, and actually two questions into one. If a customer opts for restructuring, Shyam, to what extent does that grant you grace period in terms of NPA deferment? And secondly, what is the provision that you've made on the interest on interest waiver?
No, we've made a provision despite the fact that we may not have to, about 9.67 crores or 10 crores this quarter on accounts that are greater than 2 crores and where interest on interest has been levied. And if the government were not to refund, the impact is we made the provision already. So we are well taken care of. Your first question on if a customer has sought restructuring, first we must understand restructuring, there are some filtering criteria. Not everybody can. You need to be standard as of March 1, and a bunch of factors have to be factored in. This time the regulatory guidelines on restructuring is abundantly clear. You can't just green it up, evergreen it, right? So if somebody qualifies those filtering criteria, we will be happy to offer the restructuring. And in that, as we do that, customers will hopefully honor their commitments. If they don't, we made the provision for that.
Sure. Shyam, great to have you on the show. Thank you so much for taking the time and speaking with us.